The terms trading and investing are used extensively with regard to the stock market. Oftentimes, I have come across people using the terms interchangeably. However, trading and investing are not synonymous. There's a world of difference between the two. In this video, we'll dispel some of the myths that people harbor about the two concepts. We will understand the terms stock trading and stock investing, examine in detail the differences between them, and discuss which of the two avenues offers higher returns. Before we begin, I'd like to state that this video is meant for educational purposes only. The intent of the video is solely to provide an explanation of the aforementioned concepts. Views expressed are personal and not endorsements. Opinions should not be construed as investment advice or recommendations. Now that we've got that out of the way, let's dive right in. Like I mentioned earlier, stock trading and stock investing are poles apart. However, there is one similarity between a trader and an investor, that is, both have the same goal of earning handsome returns in the stock market. What's different though is the approach that each one takes in order to achieve that goal. In other words, despite sharing the common goal of making money in the stock market, traders and investors go about pursuing it in radically different ways. Let's delve deeper into the subject to understand it better. The main difference between a trader and an investor is the time frame for which each one holds shares of a company. An investor has a long-term perspective and tends to buy and hold shares for years together, sometimes even for several decades. A trader, on the other hand, engages in frequent short-term transactions, sometimes holding stocks for as little as a few minutes. Key takeaways from what we've covered so far are: both stock traders and stock investors have the same goal, which is making money in the stock market. Investors and traders follow vastly different approaches to achieve the same end. An investor has a long-term outlook, whereas a trader focuses on short-term gains. As I've already mentioned in the video, stock traders hold their positions for shorter periods of time. They can be broadly classified into four main types: scalp traders, day traders, swing traders, and position traders. Scalpers or scalp traders execute trades which last from seconds to minutes. Day traders. As the name suggests, a day trader opens and closes his position on the same day. Swing traders take positions lasting from days to weeks. And finally, for position traders, the holding period may vary from weeks to months. In contrast to trading, investments are held for a minimum of 1 year. Sometimes, investors end up holding shares of companies even for several decades. Let's now do a detailed comparison of stock trading and stock investing to understand the differences between them. Investors are concerned with the value of a company. They invest their capital in companies that are expected to grow exponentially in the long run. Traders take advantage of short-term fluctuations in price movements of a stock to earn their profits. Investors believe in the buy and hold principle. Their total return comprises of capital appreciation and dividends. Traders seek to profit from both the upward and downward price movement of stocks. Traders can use short selling to make money in falling markets. I have explained the concept of short selling in an earlier video. You'll find a link to it in the description below. Investors are required to conduct extensive research on the company they plan to invest in. They need to study the company's financials, understand its business model, and learn about the management to make an informed decision. A company's future prospects are not of much consequence to traders, as their strategy involves entering and exiting positions on a frequent basis. Hence, not much research about the company is required. However, traders must keep track of current events as they tend to influence stock price movements. An investor uses fundamental analysis to assess a company's intrinsic value and determine its future growth prospects. Traders must possess knowledge of technical analysis to formulate their trading strategies. This involves reading chart patterns and graphs and using various technical indicators. I will cover fundamental analysis and technical analysis in detail in my future videos. An investor does not need to spend time checking the price movements of a company on an everyday basis. A trader must remain vigilant and devote time on a daily basis to analyze charts so that he can make the right trading decisions. In order to manage his risk well, an investor should diversify his portfolio. This means that he should spread his investment across various industries and sectors. Diversification can also be achieved by having the right combination of large cap, mid cap, and small cap stocks in one's portfolio. A trader should make sure to use a target order as well as a stop loss order in order to minimize his risk. The power of compounding plays a vital role in long-term investing. By continually reinvesting your returns back into your investments, over a long period of time, you can grow your wealth exponentially. Traders, on the other hand, focus on timing the market and taking advantage of market volatility in order to earn short-term profits. Both traders and investors should bear in mind certain things if they intend to create wealth through market participation. The following tips will help both of them earn good returns and minimize their risk. A trader or investor is considered successful only if he manages to achieve his financial goals. And to do so, it's imperative not only to have a plan but also to stick to it. Both traders and investors should have personality traits like emotional discipline and patience to succeed in the stock market. You cannot let other people's opinions, hearsay, or rumors influence your decisions. You must maintain strict discipline and not let your emotions get the better of you. There's no substitute for thorough and detailed research and analysis if you intend to maximize your returns and minimize your risks. Gaining knowledge about the stock market and putting it to use will undoubtedly help you make informed decisions. We have finally come to the million-dollar question. Trading or investing, which of the two offers higher returns? Unfortunately, there's no right answer to this question. People differ in their opinions about which avenue promises higher returns. Some people swear by long-term investing while others prefer trading. There's no hard and fast rule regarding the subject. People can make money in the stock market in a variety of different ways. Generally, newbies are advised against stock trading until they gain some experience and learn the rules of the game. Investing, on the other hand, is considered safer, especially for beginners. To emphasize his belief in the importance of long-term investing, the billionaire investor Warren Buffett has famously said, "If you don't find a way to make money while you sleep, you will work until you die." Closer home, Mr. Rakesh Jhunjhunwala has made millions from investing for the long term. At the end of the day, gaining personal experience in the stock market is the only surefire way to find out whether investing works better for you or trading. I hope you enjoyed watching this video as much as I did making it. Make sure to subscribe to my channel and click on the bell icon to be notified about my upcoming videos. Also, don't forget to hit the like button and share this video with your friends. Now, I'd love to hear your thoughts. Would you prefer trading or investing in the stock market, and why? Do let me know your views in the comment section below. Thank you for watching my video. Take care, and I'll see you in the next one.